Ad valorem taxation is one of the central pillars of the real estate tax system in the United States. Building on the previous section's discussion of taxing entities and tax districts, this section explains how real estate taxes are calculated, assessed, adjusted, and collected. For any real estate professional, understanding ad valorem taxation is essential because it affects purchasing decisions, investment returns, ownership costs, and client advisement at both the national and local levels. Ad valorem is a Latin term, meaning according to value. Property taxes assessed on an ad valorem basis focus on the value assigned to a parcel of real estate, not its income, not its size, and not the owner's financial status. This value-based structure ensures that property owners contribute proportionally to the cost of public services, reflecting the relative worth of the land and improvements they own. Ad valorem taxation. General property taxes are levied according to the assessed value of property. The assessed value is determined by county or township officials, such as assessors or appraisers, based on state law. Although the tax rate applies to the assessed value, the tax owed may represent only a percentage of that value depending on state formulas. Land and improvements may be assessed separately, and taxes are typically paid annually. Because ad valorem taxation is tied directly to property value, understanding how those values are determined and how tax rates are applied helps real estate professionals guide buyers and sellers with accuracy and confidence. Tax base totaling. The tax base of a community represents the total assessed value of all real property within the boundaries of the taxing district, excluding any properties that receive partial or complete exemptions. The tax base is calculated as tax base equals assessed values minus exemptions. Taxing entities rely on the tax base to generate revenue. They begin by determining the total funds they need for operations and services. Then they calculate the tax rate necessary to meet that revenue requirement. The tax rate is applied to each individual property's taxable value to produce the tax owed by that owner. Value assessment, assessors or appraisers appointed by county or township offices determine the assessed value of property. States may use different methods, including cost approach, sales comparison, or a combination of both. Assessed value often differs from market value because it is governed by state statutes rather than market-based appraisal standards. After determining assessed values, assessors notify property owners. Other tax officials, not the assessor, establish the tax rate and levy. This separation ensures that value determination and revenue needs remain independent processes. Equalization. Because assessments may vary from district to district, some states use equalization factors to create fairness. If a county's assessed values are consistently lower than statewide averages, an equalization board may apply a factor, such as 110%, to bring those assessed values up to meet uniform levels. Equalization ensures equitable distribution of tax burdens across regions. Appeals. Property owners are entitled to challenge their assessed values but cannot protest the tax rate itself. Appeals must be filed within a specified timeframe and supported by evidence, such as comparable sales, market data, property condition issues, or proof of inconsistent assessments among neighboring properties. Appeal boards or review boards handle these protests, and if the owner is dissatisfied, the matter may proceed to court. Homestead exemption. A homestead is a property used as a primary residence. Many states offer homestead exemptions, which protect property owners in two major ways: protection from certain creditor actions, reduction of property taxes by exempting a portion of assessed value. To qualify, a homeowner typically must be the head of household and must occupy the residence for a required period. Some states extend the exemption to single individuals. Depending on local laws, homeowners may need to apply annually or may receive the exemption automatically. Homestead exemptions protect equity from creditors and reduce the taxable value of the residence for property tax purposes. However, IRS liens can override homestead protections, as federal tax debts supersede state-level exemptions. Example of homestead protection. A homeowner with significant equity may protect a portion through homestead exemption. If the IRS places a lien for unpaid taxes, it may still seize and sell the property, but must allow the homeowner to keep the exempted portion of equity as determined by state law. Property tax relief example. If a home has an assessed value of $202,500 and the homestead exemption is $25,000, the taxable value becomes $152,500. This directly reduces the tax bill, sometimes by thousands of dollars annually. Exemption programs vary, and additional exemptions may apply to seniors, veterans, disabled individuals, or other qualifying groups. Other exemptions. Certain properties are exempt from taxation entirely. These include government-owned properties, properties owned by churches or nonprofit organizations, property owned by qualifying senior citizens, widows, or disabled individuals, properties owned by industries receiving temporary incentives for economic development. Exemptions reduce the tax base, requiring local governments to adjust rates or budgets accordingly. Tax rate derivation. Each taxing body begins by establishing its annual budget. After calculating all other revenue sources, such as fees, state funds, and grants, the remaining financial need becomes the tax levy. The tax levy is divided by the tax base to determine the tax rate. For example, if a taxing district requires $500,000 in property tax revenue and the tax base totals $15 million, the tax rate is 3%, or 0.03. This may be expressed as 30 mils, $3 per $100 of assessed value, $30 per $1,000 of assessed value, 3%. Some states restrict how much tax rates may rise each year, limiting increases unless the tax base expands. Tax billing and collection. Each property owner's tax bill is calculated by multiplying the tax rates of each district by the property's taxable value after exemptions. For instance, if a property with an assessed value of $80,000 qualifies for a $25,000 homestead exemption, its taxable value is $55,000. If the school district rate is 5 mils and the county rate is 2 mils, the tax bill is determined by multiplying the applicable millage rates by the taxable value. Tax bills may be due annually, semi-annually, or quarterly, depending on state law. When a lender maintains an escrow account for taxes, the servicer usually pays the tax bill on behalf of the owner. Review summary. Ad valorem taxation is based on the assessed value of real property and forms the foundation of local government revenue. Tax assessors determine assessed values. Equalization boards correct imbalances, and property owners may appeal assessments but not tax rates. Homestead exemptions provide protection against certain liens and reduce property taxes. Tax rates are derived through a formula based on budget needs and the tax base. Understanding how these components work together allows real estate professionals to help clients estimate ownership expenses accurately and navigate tax-related questions confidently. Discussion. Why is ad valorem taxation considered fair by many taxing bodies? Answer. Because it is based on property value, owners with more valuable property pay proportionally more toward community services. Why would a state use an equalization factor? Answer. To correct inconsistent assessments across districts and ensure uniform taxation. What is the purpose of a homestead exemption? Answer. To protect homeowner equity from creditors and reduce property tax liability on a primary residence. Why can property owners appeal their assessed value but not the tax rate? Answer. The assessed value is specific to the property, while tax rates are set by governing bodies and cannot be individually contested. Closing remarks. Ad valorem taxation plays a major role in home ownership, affordability, and investment decision-making. As you progress to the next sections of Chapter 19, you will learn how assessment ratios, valuation methods, and equalization formulas further shape the property tax system. Mastery of these concepts is essential for advising buyers, sellers, and investors with skill and accuracy in every market across the country.